and we are going to get to the beginning of the beginning of the beginning. This is going to be a video about what is Forex, as the title says, a beginner's guide. This is going to be a series of episodes for all my beginners out there, and for anybody who wants to refresh on what it is that they, missed in the past or anything like that. So let's get right into the video. So I want to begin this video. We're not going to focus the details of exactly, what is a pip, or what is, this type of term mean, or what does, all these different kinds of terms that people use to explain on the news what is happening and everything. We're going to focus, it's our main focus is to lead to something where you're not, you don't have too much information in your head where it starts to cloud your productivity and your understanding of what is happening in the market. Because too much information, what I learned, it starts to lead to emotions, and you start to doubt yourself, because you start to ask the question, what if this, what if this, what if this. You start to ask too many questions when you're about to enter the trade, or you're about to exit a trade, or anything like things like this. So on that note, let's get right into it. So Forex is a price valuation between two currencies or commodities. In layman terms, it means the exchange between currencies. Could be the dollar to the Australian dollar, could be the Canadian dollar to the US dollar, could be the euro to the dollar, could be gold to the dollar, could be silver to the dollar, could be oil to the dollar. Those are commodities. So it's two pairs that exchange between each other and give a price valuation. So people, institutions, hedge funds, all of those could look and see what it is, the price that is asked at the moment when they are conducting a transaction. Institutions such as banks, hedge funds, governments, they use the exchange currencies every single day to conduct their business. So, when you hear about an institution, trading or selling a certain loan or anything like that, they are pairing it back up to what is the exchange rate going to be at the time, or what they think it's going to be at the future, so they could make money on that. Now, when you see the price fluctuate between each other up and down, this is referring to the transactions happening. It is referring to, I don't want to get too much in details right now in this first video, but it's referring to the ask and the bid, which is basically how much somebody's asking for at a certain time of the price, and how much somebody's willing to pay for at a certain time of price. So, like, for example, you'll have, two different prices, as you can see on my chart right here. You'll have 1807.15, and then you'll have 1807.76. So the price is, the spread between those are 61 cents. So it's between the two. That is the price at the time. Now, it's different for all different kinds of brokers, but I'm not going to get into that. Let's stick to the beginning of everything. So now another note is, you want to look at currencies and Forex market, the foreign exchange market, FX, whatever you want to call it, is a $4 trillion traded every day. It is the largest single market in the world. It is traded literally $4 trillion a day, transactions go in and out between the euro and the dollar, between the yen and the dollar, between anything, any currency in the market. It is $4 trillion. Any commodity in the market is $4 trillion transactions. It is not a small market. That's why banks and institutions are the ones, and governments also, forgot to mention that, are the ones that really truly move the market. Little guys like me, we are considered retail traders. We're not considered institutional traders. Retail traders are, it could be anything, nobody knows the exact real number, but there's different types of terms that people use. Some companies, some institutions, some outlets like to say, you're no longer a retail trader if you are trading the commodities or the foreign exchange market if you have a valuation of over, I think it's over $100 million. It's somewhere up there. It's 100 or 200 million. I forget the number exactly, but it is a high amount of money. And I'm pretty sure anybody on YouTube claiming that they have $100 million is not going to be explaining to you in a video like this. But we're staying humble, trying to reach our goals, trying to help people reach their goals in trading, and I love that satisfaction. Again, now we are getting into a little bit more details. So, what is it that really moves the market? Really consistently moves it up or down, or even sideways? Sometimes it moves sideways. You can see here it moves sideways for a little bit. You can see here it moves sideways. Sometimes it moves directly down. Sometimes it moves continued down, moves sideways, and it continues. It's what really gives price. So that would come down to, pretty sure everybody heard this term before, supply and demand. So supply and demand is what moves Forex in pretty much any market out there. I can explain supply and demand in a very quick way. The majority of people will understand this understanding. It's an example would be if you had an American muscle car right now in the price that they are right now. For example, let's say a 1967 Ford Mustang. At the price, I don't know exact number it is, but I know it's over 100 grand. It's way up there. The only reason that car is worth so much is because the supply is so low and the demand is so high. So there is so much people out there that want this car. The problem is there's not a lot of it. Could you sell that exact same Mustang, but different year, same tweaks, same everything to it, except it's not 1967 Mustang? Could you sell it at over 100 grand? Very doubtful, because Ford would make, millions of them if they could sell it over 100 grand. The thing is once you have too much supply of something, there's no longer demand for it. Nobody's willing to pay that top dollar for it. So once you have a high demand for something, price is going to go up. If people stop wanting to buy muscle cars in the future, all of these cars that you see that are in the hundreds of thousands of dollars, even sometimes millions, those are not going to be worth that much. Those are going to drop heavily in price. So that is how the Forex market works. It works on supply and demand. So when you have, for example, too much supply of something in the market, nobody's willing to buy at a certain price. So for example, over here, nobody's willing to buy anymore in this area. On the chart, I don't want to get too much in the charting, but charting will come in a later video, but I'm just going to show it real quickly since we are on a chart. Nobody's willing to buy, for example, gold in this area. So price is not increasing. So what happens is you get a drop, and you get a heavy drop until price corrects itself, until demand comes in. So supply came in too much over here, so price dropped. and you had, for example, a different area. Let's say, for example, over here, if we go back all the way, you had, you know, price come down to here, supply was no longer in the market, demand started to come in. Demand started to come in, started to buy, and we just kept on going. People would not sell. So you had price increase. That is exactly what the market is. It's supply and demand. Nothing more, nothing less. Now, the last point I would like to point out before later on, next video, we will discuss more in depth about details of Forex, would be there is different ways of valuing a currency pair or commodity pair. There's a different ways to value the price. There's two actual different ways. One of the two most common ways are fundamental analysis, which is news, events, certain kinds of speeches that will happen from a government, from an institution. So if, for example, there was going to be news about unemployment, about the US dollar coming out, that affects the market because a lot of people trade off of, emotional aspect of what do they think people will start doing. Will people stop spending a lot of money? Will people start spending a lot of money? So it affects the market. So people's reactions start to come into price. So that's news. And then fundamental analysis is which I mostly trade. I would say 99% of my trades are based off of, you know, technical analysis, not fundamental analysis, because technical analysis to me shows what it is happening at the moment. Because for Forex, I do not look for long terms. It's a little bit different than stocks, where a lot of people will invest, where they put their money and let it sit for months, even sometimes years down the line, until they get to the price that they want to be at. For Forex, the price is always going up and down, and in cents of terms, it's going in pips. It goes up and down fractions of the price. But that fraction of the price is a lot of money when it moves a certain amount. So technical analysis is mostly about the charts, what is happening with supply and demand. It is how people are basing their price off of when they want to sell, when they want to buy a position. They are looking at the charts as far as history goes, as far as what it is that's going to happen in the future. That is mostly price action. And I'm going to end on this note because our next video is going to be about the introduction into price action while we discuss what is a chart. It's more going to be, our discussion is going to be about the chart. So hopefully guys you like this video, please subscribe and share this video so we can keep making these videos. Peace out.